Hi, my name is Adam Clavelle, and I am currently taking Professor Cresson's Finance 381 class for the summer term of 2017. Now, the project assigned was to pick 3 companies to find out which ones to buy equity in, and which ones to give short-term loan to, and which ones to give a long-term loan to, and all using the Bloomberg Lab to pull financial analysis to provide data for my assertions. Now, to start off, the 3 companies I have chose were IBM, which is International Business Machines Incorporated, providing computer data and computer software, computer products, and Walmart Superstores, which I'm sure we all know, and Apple Incorporated, which provides software and or Apple products, which are computers, phones, etc. Now, all are very known companies in today's market, but for IBM, to start off, I decided to buy equity in and to extend a short-term loan to. Now, I chose to buy equity in this company because the returns on equity seem to be the highest out of the companies that I have chosen, and the returns on equity seem to stay in the range between 70 and 100, which I seem to like, and I also would want to drive the debt equity ratio down slightly because it's kind of high and it is consistent. So their profit margin as well is not too bad either. Oh, excuse me, sorry. But it's not as high as Apple's profit margin. But the difference is that Apple probably keeps more in its profits than what we would give, or than what they would give in return on equity. And I would also provide a short-term loan to them because they seem to be fairly efficient with their assets as far as their current ratio, which is right here, is concerned. And it's not too high, and that's kind of what we like to see. They seem to be fairly efficient with their cash, and they seem to not have a lot of cash on hand. So also after looking at their total debt ratio right here, they could probably use some cash from the loan to pay off some of their debt, which would in turn also drive the debt to equity ratio down, and this would be better on times interest earned ratio because it's starting to go down as time passes, as we see here. Now, we want IBM to be able to afford their debt that they have taken. So for that, I have chose to buy the short-term loan to. Now, for Walmart, I chose to extend a long-term loan because their returns on equity are not what I would sink money for into equity, but their profit margins are not as high either. So it's just not something that I would sleep on knowing that I have equity in. But I really just don't think it's a smart investment as the other 2 corporations that have chosen to buy equity in for this project. So as far as Apple is concerned, I chose to buy equity in this company because their returns on equity are slightly higher than Walmart, and I feel like this company is going to grow much more in profits on other than other companies that are in the market because they just came into some debt, which I can see up here. And I think that the equity ratios are going to stay consistent with the returns on equity. And given the fact that given the fact that they have stayed within the range of 30 to almost 47 on returns on equity, it just seems like a better equity option as far as buying stock in the company. But also, I chose to extend them a short-term loan because it looks like they just recently came into some debt as far as the total debt ratio and the debt to equity ratio are concerned within the past few years. And I'm not too sure if those debt ratios are really going to go up or down. So as a finance expert, as far as Cresson concerns us, I think it would be smarter to go with this company in the short term because they have gone to the debt during the short term in the past few years. So, I don't really know if these are going to go up and or down. So I just feel like it's a better option to stay with them in the short term as far as these ratios are concerned. And I just feel like it's going to be a better option as far as making money from my company goes.